In this video, I'm going to look at the most discounted stocks that I've looked at in the last 2 years, coming out of 368 total stocks that I've evaluated, coming from live streams, member calls, and video requests. This will highlight the most discounted stocks that I've got in this particular data set. I'm also going to look at the stocks that look the most expensive, meaning they are priced way too high, looking at both extremes, what looks to be the most discounted and what looks to be the most high priced. As mentioned, 368 companies are what's in the database that I've got of companies that I've evaluated. And I have updated the valuations on all 12 stocks that I'm going to look at and picking out which ones look to be opportunities. In some cases, these are stocks that have really sold off. In most cases, these are stocks that are small caps, and small caps tend to be less predictable and could really outperform, but they could also go on these really long slumps until they're found by enough investors to make the stock move higher. So let's take a look. Let me take you through the best stocks that are most discounted out of my watch list, as well as the worst stocks that have the highest price, the highest premiums placed on their stocks at this time. The first stock I'm going to look at is Qfin Holdings. This stock, to begin with, analysts believe is severely discounted by 124%. The stock has sold off for the last year quite a bit, down 58.4%. It has had a recent run up at the end of 2024. The stock really went high, and in 2025 was trading at almost $45 a share, but it's really sold off. This company is located in China. It's a small cap at only $2.14 billion in market cap. So these small caps tend to be riskier, less known, and investors are less comfortable investing in these types of companies. They have a very low PE ratio of 2.68. The company has been growing, trailing 12 months growth, 14%. That looks really good. Looking at the forecast for Qfin, analysts, again, only two of them, they do cover Asia as their specialization. They believe that this year, the company is going to have a contraction in revenue growth. But then next year, 2027, they're going to have 4% growth and then really good growth of 32%. Now, I think the forecast is going to be more positive than this. Where's that coming from? I'm an investor in China, and I've been studying China. Their economy is doing well. Their exports are doing fantastic. And I think that China's economy has lagged the US economy by a couple of years due to COVID. And I think the Chinese economy is now hitting stride. It's now really active. And I think people are going to be seeking credit more often. That said, I think the forecast I expect is probably going to be better than this. So this is a stock that I'm going to look out for. This PE ratio is just set where, how low can this go? It's super low. I've updated my valuation of Qfin. I carry a higher than typical discount rate since the company is in China. It's also a small cap. And the cash flows the company produces create a 90% discount when I compare the value of the cash flows versus the stock price. And on the earnings per share, using a PE ratio of 12 that a profitable, good margin company deserves, it has a discount of 76%. So my discount on Qfin is 87%. This is a very highly discounted stock. And as we saw less than 12 months ago, when this stock gets going, it really goes up fast. So most definitely, this is on my watch list of stocks that I may start a position in 2026. eToro is a lot like Robinhood, doing business mostly in Europe. And this is a new IPO stock. IPO stocks tend to trade down in their first year of existence. They IPO'd in the middle of 2025, and they've sold off close to 40% in that time. This is a small cap, $2.6 billion in total market cap. Analysts think it's highly discounted, 95%. And its forward PE is 13. Considering that this stock has been growing well, that's a pretty low PE ratio. The analyst, they believe this is discounted. 14 analysts cover it. So it's not just a couple of analysts that are looking at the stock. They think it's highly discounted. What they do agree on, this company is going to keep growing, almost 9% in 2026, 10% in 2027. This is a profitable company generating free cash flow and bringing down their PE ratio down to the single digits in 2029. When I value eToro, I arrive at a 64% discount on the stock. That's a real attractive discount on a company that has a business model that I totally get. I've been a successful investor in Robinhood and Futu, which is doing the same thing in Hong Kong, China, and Asia. And I'd love to own this stock at the right time. It's near its IPO, so I'm going to give it some time and see when the rally begins in eToro and really be ready to buy some shares in this really good company. FinVolution, the next stock, and this stock is also in China. And China stocks have been performing really well. If you look at the Hong Kong stock market, it's outperformed the S&P over the last year. And this stock, if you look at where it's been in the last 5 years, you see that it really had a nice rally in 24, 25, but it's really settled down. Analysts think it's highly discounted. It's a $1.3 billion market cap company, another small cap. Forward PE is only 3.5, and it pays a dividend. The company has been growing, and there is a contraction expected on its top line revenue. 12 analysts cover the stock, and the contraction on revenue is expected here in 2026. So I can understand some of the selling. Next year, 2027, it's supposed to start growing again. And if they surprise to the upside on this growth, this stock's going to take off. Its PE ratio is really low, so it's really attractive. The numbers really look good on FinVolution. When I value FinVolution based on its book value and the value of its earnings per share, I get an 87% discount on this company. One more small cap where the numbers look really good. And this stock, once it establishes a rally, I'd love to get into this stock as well. This would be a total buy if the stock begins to perform well in 2026. GoodRx is really sold off over the 1 year, down 45%. And over the 5 year, boy, this has really been left for dead. And I don't quite understand why the market is so put off by this small cap company. The market cap is less than $1 billion of market cap. Its forward PE is less than 16. And analysts think there's an 86.7% discount available on the stock. The company has been growing, although the growth hasn't been all that great. But let's take a look at the forecast. 10 analysts are weighing in on that discount that they believe the stock has. And I'm seeing some growth on the horizon. This year, 2026, is going to be slow growth, but it's really going to pick up next year. And then the year that follows looks really good. That's going to bring up their earnings per share. Their earnings per share is going to grow faster than revenue, really bringing down their PE ratio. How low can a stock go? This one is really priced at a high discount. When I look at GoodRx and I value the stock, I come up with a 58% discount available on GoodRx. This company is an online business. I like those types of businesses. And they're in a good area too, healthcare. So this is really a stock that I want to track, watch, and potentially buy into in 2026, because once it starts moving, I think this stock's really going to go up fast and probably double in value very quickly. Root Incorporated, they sell insurance products in a new format, separating themselves from the traditional companies like Progressive and Allstate. Their stock's down 15%. It's a small cap at just $1 billion in market cap. When it IPO'd, it had a very high stock price, but it's really come down. The forward PE is 44. That's a pretty expensive forward PE. Analysts do think there's a big discount available on Root. Looking at their historic growth rate, the growth rate has been really good. So that looks fantastic. Now let's take a look at what is being forecasted. 5 analysts are weighing in and believing that the stock is discounted by 76%. When we look at growth, this year they're going to grow by 6%, followed by 10, and then followed by 13.8. These are good growth numbers, especially for a stock that's been discounted. It's going to bring down their PE ratio down to 31 and then 20 in 2027. So this looks like a really good stock in the right space. They compete against companies that have been selling insurance somewhat of the old-fashioned way by doing a lot of TV ads and ads online as well. These guys have a customer acquisition model that's very modern, and I think better than Allstate and Progressive. So most definitely, this is a very closely watched stock for me that I wouldn't mind buying in 2026. When I value Root, I get a very attractive discount of 76% discount on this stock. Principally, it comes from the value of those free cash flows. The company's already producing free cash, and the growth rate looks really good. They are growing better than Progressive and other legacy insurance companies. So that looks like a really neat opportunity for a company that's trying to reinvent the way people are going to buy insurance going forward. NextPower is a company that provides products for the solar industry. It helps those that use solar power get more of that sunlight and produce more power with its devices, both for commercial and residential, but mostly for commercial. This is a $15.5 billion market cap, and the stock has flourished over the 1 year, up 154%. Over the 5 year, it's up 337%. Analysts think it's fairly priced or maybe at a 10% premium. Forward P of 25. One of the things I like about NextPower is its growth. Has been growing quite well. And when we look at their forecast, 19 analysts covered the stock. The stock has moved quite a bit higher, and the growth is expected to stay consistent going forward. In the year that they're closing out on March 31st, they're going to grow at 17%, followed by 11.5, 13, and then 12%. Those numbers look terrific. And its PE ratio is coming down. So this is an attractive stock, although the stock price has been bid up. When I value NextPower, I get a 73% discount, which is a very high discount on a business that has been performing well, growing its business. The stock market has found the stock and has started to invest in it. And overall, if there's a nice pullback on this stock, it most definitely would be a stock I would consider buying for my portfolio. So I've covered the stocks that have really high discounts available. Now let's take a look at stocks that are priced way too high. And we're going to start off with symbol BE. Bloom Energy. Over the 1 year, it's up 467%. Incredible. Over the 5 year, it's only up 260%. Interesting. Now, this company installs solid oxide fuel cell systems. And in the power generation space, it's really gotten a lot of attention. We need more power overall, especially at data center sites. The market cap for Bloom is $34.2 billion. Its forward PE is 168. Whew, that's a high PE. Analysts think it's priced 43% too high. And the company is growing nicely. Trailing 12 months growth of 44.5%. When we look at the forecast, and 20 analysts are weighing in, on average, they think it's priced too high by 43%. The growth in revenue is going to persist. This year, it's supposed to grow by 30.8, followed by 71%, followed by 41%. Those are very good growth rates. And its profitability is going to go up. But that PE ratio is going to stay high for a while. In 2028, it's still going to be at 34. So this is a stock that is priced to really grow, maintain its growth, be profitable, and just the fundamentals look expensive as I look at the numbers. I valued the Bloom Energy stock, and I think the stock is priced 73% too high. The company's doing great, but based on their free cash flow, the company's only worth a certain amount. And also based on their profits, it's only worth a certain amount. That said, I agree with the analysts that this stock is priced way too high. If there's any kind of pullback on the demand for its products, this one's really going to tank, and I'm going to stay away from Bloom Energy. Xpeng is a company in China producing automobiles, and they're doing great in growing their business. But the automobile business, there's just not a lot of money to be made in that business. Over the 1 year, this stock is up 32%. Over the 5 year, it's down 65%. This is an $18.3 billion market cap business. Its forward PE is a whopping 92. Analysts think there is a discount available on Xpeng. Its growth is really fantastic, but there's not a lot of profit left for the company, even though they sell a lot of cars. When we look at their forecast, they're going to keep growing, and its earnings per share should be good in 2026, but not good enough to really substantiate the stock price. I've updated my valuation of Xpeng, and I come up with an 80% premium, meaning the stock is priced 80% too high. I'm valuing the company based on the cash flows it's going to produce in the future, as well as the profits it's going to produce. And I'm just not getting to their stock price. So this would be an absolute sell for me. The car business is not a great business to own. And the additional bad news, especially for domestic producers here in the US, is XPeng is really growing the number of units that they sell of their cars. They're really bringing down the price of cars, and they're not making a lot of money as they do so. So I'll let somebody else invest in XPeng. It's not the right investment for me. Walmart is the next stock that I think is priced way too high. And the stock has gone up 26%. Over the 5 years, it's gone up 141%. This is a stock that Its margins are lower than, let's say, a technology company or a biotech company, much lower. And their forward PE is a whopping 41, even though they have good growth, but it's single digit. It has a whopping market cap of 938 billion. And analysts somehow believe it's fairly priced, and it's a strong buy. It's a recognizable stock, I agree, but they're only growing at 4%. How could investors be so excited about a company with such slow growth? But analysts are going to go with what the market thinks it likes. In this case, a recognizable name in Walmart. That is a slow grower. It's growing its profit nicely. But to buy into a very legacy industry like consumer retail, discount retail, and pay the same PE ratio that I would pay for a really exciting technology company just doesn't seem right. When I valued Walmart, I've come up with a 54% premium on the stock. And that's just too much of a premium, especially since there are alternatives if I want to buy a retailer. For example, I think Target provides a really nice discount and can really have some really good upside. For me, Walmart's an absolute sell. We'll see where this stock goes in 2026. CloudFlare is the next company I think is priced way too high. The stock is up 41% over the 1 year. It's up over 100% in the last 5 years. This has become a $60 billion market cap company with a very high PE ratio of 154. Analysts think it's discounted by 31%. Its growth is good, but there are other cybersecurity stocks that have similar growth with a lower PE. A total of 26 analysts are covering this stock, so there's plenty of opinions on Cloudflare. Its company is going to grow by 27% in 2026, 28% in 27, 26% in 2028. And its profits are expanding nicely, but that PE ratio is really high. Geez, this is a really expensive stock based on the PE ratio. When I value Cloudflare, I arrive at a 73% premium. The stock is priced 73% too high based on the value of its cash flows and based on the value of its profits. I could find other stocks like Fortinet or Okta that are discounted at this time. So I'd rather buy those and pass on Cloudflare. Enbridge is the next company, and Enbridge provides the pipelines to move natural gas. And they have been doing fairly well. This year, their stock is up 7.69 over the 1 year. And they pay a nice dividend of 5.59%. It's a $105 billion market cap, and analysts think there's a discount. Its PE ratio is 22.47 for the forward PE ratio. Now, it's flourished during a time when natural gas prices had been going up, but they have been going down recently. And the two analysts that cover it think there is a discount available on Enbridge, but the forecast shows some trouble ahead. It's going to contract a bit here in 2026, which I agree with because natural gas prices have been going down. There's less demand than expected. And next year, they're going to grow a tiny bit, 3.19. And then the year after, they're going to contract a slightly bit. So overall, the P ratio for most companies, this looks reasonable. But within this space, I think it's too high. I valued Enbridge, and I believe the stock is priced 66% too high. The company carries a lot of debt, which decrements their value. Their free cash flows are going to be dedicated to paying that debt off. In fact, that's where I think the stock is priced 90% too high if I look at their cash flows and the amount of debt that the company carries. I'm a little closer to fair value on the earnings per share, but that's not enough to bring the overall valuation on the positive. In fact, the 66% premium is just way too high, considering that I've got great options within the energy space to invest in that have better valuations, better fundamentals, and far less debt. Tesla, this is one of the more popular stocks that is traded, and it's up 8% over the 1 year. It's really had a nice rally coming out of the April timeframe. This is a $1.5 trillion market cap company with a humongous forward PE of 230. Now, I showed XPeng earlier and commented on the low margins the automotive industry has, and that's the case with Tesla. They sell a lot of cars. There's very little margin on those cars. Analysts think it's priced a little too high. And we look at their growth, there is none in the trailing 12 months. It's contracting. And the forecast is that the company is going to have good growth in 26, 27, 28. Again, the profits are not very high in the automotive business. Investors in Tesla believe they're buying a technology company, and they may be right, but they're also buying an automotive company. Tesla produces a lot of cars. That's just what they have as their primary product, and that product doesn't make a lot of money. And that's what I take into account when I look at an investment, when I look at a stock like Tesla. When I value Tesla, I come up with a 76% premium. And at times, Tesla's really sold off, and at times, it's really rallied. I don't know what it's going to do in 2026, but the fundamentals tell me that Tesla is a complete sell and not an investment that I will make in 2026. So to summarize, there's some really fantastic discounted stocks out there, especially with small caps. In China, FinVolution and Qfin have terrific discounts, and those stocks have shown to really rally quickly. So I'm going to really keep a close eye on those stocks. Root is trying to reinvent how people buy insurance in the US. I really like their ideas in the space. And NextPower is a terrific discounted stock that is providing products for the solar industry. GoodRx is an online company, love online companies, and these guys are going to have some growth and they're so discounted. How far lower can the stock go? I don't think much more. And eToro has been proven to be a growing business, and we are close to their IPO, but as we get further away from that IPO, eToro is going to be very investable. So these are the stocks that I'm really watching, and will be likely adding one or two or maybe even three of these in my portfolio in 2026. Now, the stocks that I think I'm just going to watch because I think they're going to really give up a lot of their price is Walmart. I think it's really comfortable for those to invest in Walmart, but I made the same call on Costco about 2 years ago, and Costco's really underperformed. I think Walmart's going to suffer the same fate. Enbridge is just going to really suffer because there's better alternatives in energy than Enbridge. CloudFlare is really getting bid up based on its revenue growth rate, but its free cash flow and profitability just don't add up to its stock price. Bloom Energy is much too high, and I think is going to sell off. Xpeng just doesn't make a lot of money. Even though they're growing their top line, there's not a lot of money in the automotive business, which is the same fate that I think Tesla is going to experience. Is the car business just doesn't make a lot of money. Therefore, you can't load up your balance sheet with free cash. And you're going to always struggle to be compared. If you are truly a technology company, then get compared to Palantir or some other technology company. And you'll see that Palantir has 80% gross margins, while Tesla is way down on the gross margin level. And the profitability is also single digit, while companies like Palantir and other software businesses are in healthy 20, 30% net profit margin zones. So that is my video. This is from the community request of stocks to be analyzed, to be priced, valued. And out of 368, here are some of the best on that list and some of the worst, some that are priced way too high. I hope you found it interesting. I think in 2026, studying where there's opportunity is going to be the way to outperform the market. I think small caps are going to be a good idea. China's a good idea. And finding stocks that are not as well known, buying them at the right time, and then participating in the run up in those stocks. So that's my video on the best and worst stocks on the overall watch list that I provide members of the community.